Hey everyone, me Kevin here. Welcome back. Oh my gosh, we've got a lot to talk about because we just got some nasty numbers that came out. So breaking news on these nasty numbers. We're also going to be talking about a lot of these ticker symbols towards the latter part of the video. We also have a sponsored message by aura.com/meetkevin, but more on them in just a moment. First, oh my gosh, look at this chart, folks. Consumer credit. Holy moly. First of all, we're up an annualized 10.1% since the last month. That is a lot of debt growth to be growing debt at 10% a year at an annualized rate. But look at this. On the far right there, you see that highlighting there at the tippy top right over there. Look at that, folks. We had $47.3 billion in increased debt in March, followed by now $38.1 in April. I drew sort of a yellow line there to try to give us an average of the past maybe 10 years, although this chart goes all the way back to the 90s, early 90s. And boy, oh boy, these are some of the largest drawdowns of credit that we are seeing. We've also seen revolving credit. Look at this. Jump $17.8 billion after 25 the month before that. And I wrote some numbers on here. Look at this, folks. 537 million credit cards opened in the first quarter. If you just assume people who have social security numbers and who can qualify and who are of age in the United States, that works out to 2 to 3 credit cards opened in the first quarter per person. And things just started getting bad in the second quarter, like April and May. So it's no surprise that you're starting to see banking CEOs U-turn on their argument that, oh yeah, the consumers are fine. They've got plenty of savings. But don't worry, we'll talk about what the banks are saying. We'll talk about what is going on with the Atlanta real GDP. We'll talk about margin all in just a moment. But this consumer debt information is scary. And I mentioned this not because we're trying to pass FUD on, but it's weird and it's not sustainable. Why is it that we have consumer sentiment levels at 2008 levels? Consumer savings rates under 5% at 2008 levels. Yet all of a sudden, people are spending this much money on debt. Why are they drawing down debt? Do they think that debt is about to get frozen like what we saw in 2008, that we'll have a credit crunch? Or are they trying to sustain a previous lifestyle that they had during the stimmy days? Or do they need to because inflation is outpacing what their income is actually growing at, and therefore they have no choice but to go into debt? And this is dangerous, debt and credit cards. Folks, let's get in a message from our sponsor, and then let's talk about some other updates and also what's on the board behind me and these tickers.
Y'all know what the fastest growing crime affecting millions of people in America is? Well, the answer is definitely, hands down, identity theft. And there's a new victim literally every 14 seconds, so we just had another one. And that's why I'm excited to partner with today's sponsor, Aura. Aura is an identity theft protection, fraud monitoring, VPN, password manager, and antivirus software all combined into one easy-to-use app. Those who have had their identity stolen are often shocked when it happens. It's a scary situation and unfortunately a reality for too many people, especially if you get your identity stolen while you're trying to buy real estate. You might not be able to buy that real estate anymore. But thankfully, Aura monitors the dark web for your emails, passwords, social security numbers, and sends alerts fast right to your phone and email. So we actually tested Aura, and when we entered our email into Aura, they monitored the dark web and found that my email and password had been exposed 3 times. So when it comes to fraud, every second matters. You can connect your credit and bank accounts and you'll get notified of any charges up to 4 times faster than Aura's competitors. Let me know in the comments how many times your information got pinged. So protect your family and yourself from identity theft at aura.com/meetkevin, below in the description as well. And if you sign up right now at aura.com/meetkevin, you'll also get a 2-week free trial for their entire suite of services at Aura today.
Welcome back. Take a look at this chart, folks. It's ridiculous. This chart right here, U.S. earners, high earners, who report living paycheck to paycheck. What is this, folks? This is all people making over 6 figures. And what do you have? 63% of millennials making over 6 figures living paycheck to paycheck? Are you freaking kidding me? Have you folks not listened to any of our videos on trying to save and get out of debt and building assets? This is a problem. Now, I know this isn't you. I know it's not you. It's the other folks. It's everyone else who's not watching the channel. This is a problem. But not only is this a problem, it's also a problem because spending will be going down. Consumer sentiment is at 2008 levels. Savings is at 2008 levels. We're seeing debt skyrocket. We're seeing inventory pile up at stores. Target's telling us basically, looking forward, hey, people just aren't spending. They're not responding to our price cuts anymore. We're going to talk about tickers in just a moment because it's going to be really interesting. We're going to talk about my opinions on some of these. But it's no surprise that when I pull up the Fed's real GDP estimate, which is right here, look at this, folks. This line here is the 0% line, and we are sitting next to 0% in real GDP. This is the Atlanta estimate. This is not the actual estimate because obviously we had a negative quarter that was not revised upwards. Still a negative quarter for the first quarter. We're knocking on the door of a negative quarter in the second quarter, which could mean we're in a recession now. If we're in a recession now, and you've got banks saying, hey, consumers right now are pulling as much credit as they can to continue spending, then maybe we'll be in a recession throughout 2023. Why do I say that? Well, I say that because Morgan Stanley tells us consumers have 3 months left of spending. That's not, that sounds pretty dire. That's actually a big problem. Jamie Dimon says people have between 6 to 9 months of spending left. And Deutsche Bank says we have until the end of 2023 worth of savings left. Now, it's possible that Deutsche Bank is saying this because if you jump over to this particular chart here, you do see that higher income groups do have excess savings left. And so maybe this group over here will stop spending early. This group will stop spending by the end of 2023. This group will stop spending, or by the end of 2022. This group will stop spending by the end of, or let's say the beginning. So we'll put B23, right? And 22 over here. This is sort of your now end of spending. And then these guys stop spending at the end of 2023. Maybe that's why you're getting this really diversified range of what banks think in terms of when consumers are going to run out of money. But let's just put it this way. It's not sustainable for consumers to take on so much debt while saving so little. Let's put it up again right here. Look at this, folks. This is not sustainable. Do not be one of these consumers. Do not be the consumer that is going into debt. Really, really, really bad idea. You want to make sure you get out of debt. Now, if there's something, if you want to help kind of make sure that you can build your wealth during these times when real wealth is built and you're prepared to get into real estate investing, or you're trying to figure out how to build your income and get on the path to wealth, make sure you check out the programs linked down below. We've got the Path to Wealth program, where even today we're filming more scenarios responding to your examples of what you're doing in your life and my opinions in terms of, hey, maybe this would be the next step to getting on that path to wealth, whether it's through real estate or whatever. Folks, take a look at all of those programs linked down below because now's the time to build your wealth. Not when we're in a bull market. Then anybody can do it. If you can build your wealth during these times, that's what matters most, because now you want to make money. But why do we have all these tickers up here? Folks, what do we got written here? Well, first thing, Procter & Gamble. What do I want to say about Procter & Gamble? So Procter & Gamble in their last earnings call told us, oh, don't worry, everything's fine. Our consumers are still preferring premium brands. What are premium brands? Well, they're things like my courses on building your wealth, link down below. Use that 50% off coupon code. It's an amazing coupon code we got right now. 50% off. It's the biggest coupon code we've ever had. Link down below. But anyway, they mentioned that folks are still spending money on Gillette products or Braun toothbrushes, basically the more expensive premium version of things because they're used to the stimmy days. Maybe because they're used to the stimmy days, they're still spending money on these things, but eventually that's going to go away. And these high margin items are going to get killed. People have right now escaped to consumer staples because they think this is the place to be safe during periods of inflation. But no, I believe that their margins will get squeezed as people start moving towards lower sort of brand value products and start going down in price to survive. This is actually where what does really well in this kind of time, dollar stores. And there's a reason that when we look at retail foot traffic and mobility data, the only category that's positive, well, next to fashion, which is barely positive, like 0.2% positive, are dollar stores, like mega discount stores, which some of them are now, by the way, because there's so much inflation, being called Five Below, which I think is kind of funny that dollar stores are turning into Five Belows. But anyway, Target. Folks, Target, Walmart, we don't even need to talk about these guys. These guys have lost the plot. They've lost pricing power. Target especially has lost their pricing power. They've got way too much inventory. They've got a terrible system in terms of inventory management. I mean, they're just getting creamed here, and they're telling us, yeah, we're getting creamed. So we already know this about Target. We know Walmart is experiencing similar rises in inventory. Remember what Kathy Wood said. Kathy Wood says, look, 50% of Walmart is the grocery store aisle. And if they had a 32% increase in inventory, you're not seeing that inventory build up in groceries. You're seeing that build up in stuff. So people ain't buying that stuff. That's bad. Keep this in mind. This is a stat from The Economist. The Economist tells us that 25% of all groceries in the United States are bought at Walmart. Yeah, crazy. But Walmart's nowhere near as cost effective as companies like Aldi or Trader Joe's because you've got super centers, too much choice. It's a disaster. Anyway, companies that I personally really think are at risk going forward into quarters. I know Lulu did well, okay? Lulu did well. They're still kind of one of the newer ones of these in the last quarter. I don't think it's going to last, but they are still a newer one sort of on the scene here. And they're doing really well as the Canadian company they are. They're kicking butt. I'm going to Canada soon, so I'll see you there. I got my Canada shirt right here, so I'm ready to go. But anyway, all these sort of athleisure companies, the Nike, the Dick's, the outdoor sporting goods, the Lulu, whatever, I think we've got risks here because I think people bought their clothing for reopen, and now they've got to kind of do an inventory check and go, holy crap, I got a lot of clothing. I'm gonna step back on the new clothing here because I got to be able to buy some food. Now, somebody in the course member live stream this morning asked a really good question. I don't know the answer to this, but I want to survey all of you on their behalf. So in the course member live stream, we were talking about cybersecurity, and we did like a 30-minute fundamental analysis on CrowdStrike, which is really just a part one. You can't do a full 30-minute analysis on one stock and think that's it. That's all the analysis. No, full analysis takes hours, right? But we learn these things. Or I teach these things, right? And so one of the things they asked is, hey, Kevin, if people spend less money in places like these discretionaries over here, is it possible that a place they might go is actually fast food? In other words, would it potentially make sense to invest in companies like Coca-Cola or McDonald's or whatever? Regarding Coke, it's worth noting that their ingredients costs have shot up so much, and they just don't have the pricing power based on their last earnings call to continue raising prices. Ketchup said the same thing. Well, Heinz, who makes ketchup? Heinz said the same thing, Kraft Heinz. So there's this risk factor about, well, I don't know, can Heinz and Coke keep delivering when costs are going up? But, and I don't know the answer to this, but I do think it's interesting, and I want to hear it from you. Do you think that companies like McDonald's, or maybe even like a more fast casual restaurant, a step down from something like maybe Cheesecake or Olive Garden, can something like Red Robin do well because now you're able to get a cheaper sit-down meal or just a pick-up-to-go meal at McDonald's, right? Fast food, fast casual. I want to know what you think in the comments down below. Personally, I'm not a big fan of the food industry, so I stay away from food. I've worked in the food industry. I think it's the most terrible industry to be in. I would never recommend somebody be in it. It's the lowest margin. It's the highest risk and liability. It's a disaster. Other companies I want to talk about, Affirm tells us that, hey, we're good. During recessions, we can grow the most because, well, people will borrow more. And I think this is exactly why Apple just released their Pay in 4 in terms of being able to do buy now, pay later. Now, Pay in 4 is really just pay over 6 to 8 weeks, which is really just like having a credit card and paying it off in 30 to 45 days when the statement comes in. So I don't really think this is innovative like what Affirm does with the partnerships where you can buy now, pay later for up to 6 months to 36 months out, right? Very, very different. This is an actual merchant partnership. This is just pay us back in 4 payments or whatever. Very, very different here. This is what PayPal does. This is what they all do. It's no big deal. But it's really the risk factor you have here, especially at Affirm, is that they keep 50% of their debt. So if you keep 50% of your debt on your books and all of a sudden your default rates are going up, which they are, default rates were under 1.5% according to the Wall Street Journal last year. Now they're sitting at about 3.4% in terms of, well, I shouldn't say default rate. I should say 30-day late because that's what it is. That is a form of a default, though. If you're 30 days late, you've somewhat defaulted, right? But this is a more than doubling of the rate of lates here. And once you get to 30 days late, the odds of you collecting this low, especially since it's not like they're going to come to your house and repossess your Peloton. It's not like they have you have car debt where they can repossess this thing. They can't. You're screwed. That is a firm screw. They take the loss on this debt. So you're going to see a lot more of an allowance for doubtful accounts, which means they write those accounts off, or at least these expenses, which is going to affect profitability, and won't surprise me if they end up not going profitable yet. Where you really want to be here is when you're coming out of a crash, where they've got so much written off for doubtful accounts and you're coming out of the crash. Well, I think you're kind of going into it now, or you're already in this prolonged recession, right? Games is a question mark for me. Games, I wonder, like, hey, personally, in my opinion, games are the best value per dollar that you spend. You go to a movie theater and you spend, $30 on tickets for you and your girlfriend and a thing of popcorn or whatever. That's $30 for an hour and a half of entertainment. You could each spend $30 on a video game like Age of Empires or whatever. Now you spent $60. So what does that get you? 3 hours of entertainment? No, it could get you hundreds of hours of entertainment, right? So I wonder if consumers will make that analysis and realize, wow, we can actually save a lot of money not going to Disney World, not going to the movie theaters, not going to the mall, not buying this athleisure kind of crap anymore, and just play video games at home and keep it relaxed. Similar, but sort of, well, actually not similar. It's similar to these guys over here, that discretionary spend. Etsy, what did they tell us in their last earnings call? No pricing power. Their merchants don't have pricing power to raise prices. I don't know if we did that on a live stream. Actually, we did this in the course member live stream. We were reading through their earnings reports and their earnings calls, and we're like, oh, yep, nope. Anyway, remember, 50% off coupon code, link down below. Okay, Shift Technology. They're knocking on the door of BK. Okay, we did probably a 20 to 30 minute analysis on Shift right here. The cash flow that they have is terrible right now. Big negative cash flows. You don't have but maybe 1 to 2 quarters of cash left. They're going to have to get a lot of high interest rate debt, or they're going to have to issue some new stock to survive, in my opinion. What else do people cut? Well, again, we talked about movies potentially getting cut. Subscriptions, that's a no-brainer. All of this started with like the Peloton and Netflix disaster, right? So that's really no surprise. Netflix was like the canary in the coal mine at the beginning of this year that, oh crap, this is going to be a tough year. Disney Plus still did well, though. They beat expectations. But one place that I thought was very interesting is it possible that during difficult times we're going to end up seeing more cyber crime? And if we see more cyber crime, is it possible that we're going to see more spend on cybersecurity? Now, I hate to say it, the price to earnings ratios of companies like CrowdStrike are freaking ridiculous. You're talking about over 100 PE ratios, PEG ratios of 3 to 4. But it's a SaaS business. SaaS business compared to like a Tesla where you sell the car and it's not yet a SaaS business via FSD. SaaS businesses, man, you with 120% retention rate like what you have over at CrowdStrike, I don't know, it's a head scratcher. These guys have come down a lot in their pricing. And it makes you wonder, can businesses spending on cyber remain resilient? Because look at Gemini, for example. Gemini is getting sued for like $20 to $30 million because they lost many millions of dollars in, actually, I think it was about $30 million. They lost about $30 million in a hack in people's retirement accounts in Bitcoin and Ethereum, and now they're getting sued for that money, which makes sense. But hey, could it have been prevented with some better cybersecurity? Software, whether that's like Cloudflare's DNS service or what is it? CDN service. That's what they do, the CDN service. Or I'm not really good at cybersecurity stuff. I'm still learning this. But cybersecurity over at CrowdStrike, there's some incredible suites of packages that you have over here for detecting malware or whatever else with their Falcon products. There's some neat things here. And so I recently have been starting to scratch my head about the cyber industry because everything's kind of painful in a recession. There's no doubt about that. But I'll tell you, there's nothing more painful than seeing the real GDP numbers next to negative, seeing a margin debt. Actually, margin debt in stocks is declining a little bit. We're about 744 million right now, a billion right now, which is way better than the 940 where we were before. We were almost at $1 trillion. That was a disaster. But this buildup of consumer debt, it's an issue. And these are my thoughts on these companies. Make sure to check out aura.com/meetkev, and the program's linked down below on building your wealth. If you got questions, leave a comment or send an email over to kevin@meetkevin.com. Thank you so much for being here, and we'll see you in the next one. Bye.